Tonight you're getting a general presentation about self-managed superannuation funds. I don't want anybody in here tonight to go home thinking that they should set up a self-managed super fund or that they shouldn't set up a self-managed super fund. What you're aiming out of tonight's presentation is to take some ideas on board and go and seek some more advice, get some individual advice, and then make your own decision as to whether or not to set something like this up. Okay, so what we're aiming for tonight, first of all, I'll talk about what a self-managed super fund is. I'll look at the advantages and disadvantages of a self-managed super fund, what you can invest in if you set up your own super fund. Then we'll more specifically go into some new provisions that allow you to borrow to buy real estate within your own superannuation fund. And we'll look at a couple of case studies at the end. Okay, so what is a self-managed super fund? First thing I'm going to talk about is what is superannuation, because a lot of people misunderstand what superannuation is. There's been a lot of volatility in the share market over the last couple of days, and the stock market itself has gone down a fair bit. And a lot of you would have seen that your superannuation account balance has fallen over the past few days. And some of you would think, well, superannuation's no good because my money invested in super has gone down. But in actual fact, the money in your super fund has gone down, but that's not because of superannuation. It's because your super fund has invested your money in a particular investment that has performed either really well or really bad or average. So superannuation itself is a structure with which you can hold investments, just like you could hold them through a family trust or through a company or something like that. If you had a small business and it was operated through a company and your business went poorly because of whatever reason, you wouldn't turn around and go, companies are a bad structure to run a business. It's what happened within the company that is the issue. It's not the fact that you're in a company. Superannuation is the same thing. It's a structure rather than an investment in itself. Okay, self-managed superannuation is, as the name implies, it's where you manage the super yourself. So if you're looking at your super fund today and saying, I'm not really that happy with how it's going, I think I could do better, maybe you feel like that, maybe you don't. If you feel you could do better, then here is an opportunity for you to prove that to yourself by running your own fund. So you are the trustee. So at the moment, if your money's with a managed fund, then there is a trustee of that fund. It could be AMP, it could be the state government, it could be anybody. They are actually the trustees of your money. They control the money, they invest the money on your behalf. You can certainly instruct them within certain portfolios. I want shares, I want cash, I want property. So you can instruct the trustee, but they control the money. You are a member of that fund. If you set up a self-managed super fund, you become both the trustee and the member. So you effectively wear those two hats. One other rule for self-managed super funds in Australia is that you cannot have more than 4 members in your fund. Please don't ask me why, that's just the legislation. You are limited to 4 members and you control all of the investment decisions. There are certainly legislative restrictions on those decisions that you can make. You can't just go and buy anything, but you do control the investment decisions within your fund. Okay, so we'll look at some advantages of self-managed superannuation funds now. The main advantage and the reason that most people go into self-managed superannuation is that they control all of the investment decisions. If you feel that you can do it better, then you need to take control. So that's the primary reason that people would go into a self-managed superannuation fund. Secondly, there is more scope over what you can invest in. Tonight you'll learn more about other direct investments that you can make, and you can make some of those investments through a self-managed super fund. We talked before that if you're in a public offer fund, that fund has a trustee. That trustee has a trust deed that regulates that superannuation fund and regulates what they can invest in. So they are not able to invest in a lot of products such as direct property, maybe artwork and things like that, that you can invest in if you are the trustee of your own super fund. You have more ability to direct the trustees. A lot of you would understand that you can make a binding nomination on your super fund at the moment to say, I would like my death benefit to be paid to a particular person. And when you make that nomination is only valid for 3 years. And it's fairly restricted in what you can say. You can say who it's to and what proportion, but that's about all. In a self-managed super fund, you can have a scope in your deed to direct all of your benefits in any way you choose. You can even have it in the deed that some of it goes to my spouse, some of it goes to my children, and the form that it's paid. So you have more scope in your self-managed super fund as to where the money can go. I've lost it on the screen, so I'm going to have to look there for now. It can be cheaper. Now, please take note of what I've just said there. It can be cheaper. So what do I mean by that? We all know that we have fees in our superannuation fund that we have now, and those fees can be calculated in many different ways. In a self-managed super fund, you also have fees, but they are generally more fixed in terms of it doesn't matter too much about how much your balance is. So for a high balance, it would probably be cheaper to have a self-managed fund. With a low balance, it would almost certainly be more expensive. Another one, again, I can't see it on this screen, but another advantage of self-managed super funds is that they have a separate land tax threshold. So if any of you invest in real estate, you would know that once you start owning a number of properties, you start paying land tax on those properties. If you then try a different structure, such as a family trust, again, you start paying land tax. A self-managed super fund is another land tax entity that has a separate threshold, which can save you a lot of money if you are investing in direct property. So now we'll have a look at some of the disadvantages of a self-managed super fund, because it's not all roses. The first one is the complexities of the law. There is a lot of legislation around self-managed super funds. You heard earlier on tonight that I have a professional certificate in self-managed superannuation from Adelaide University. They actually run a postgraduate course just on the legislation to do with self-managed superannuation. I've actually done that course twice because in the last few years it's changed so much that I needed to update myself. It is changing all the time and it is very complex legislation. I also mentioned there that you need to get advice. Not just advice about where to invest your money, that's totally separate. You need to get advice as to how to run your super fund. You've got to make sure you comply with the legislation. You have a lot of administrative duties as the trustee of a self-managed super fund. You must keep minutes. You must make minutes of all of the investment decisions you make, in fact, all decisions you make as a trustee. You must keep those minutes for 10 years, which is different to a lot of other things that you do where it might be 5 years or 7 years. In a self-managed super fund, you must keep minutes for 10 years. You must have a trust deed. You must consent to act as a trustee. You must have accounts prepared every year for your fund, even if you do nothing, and you must have those accounts audited. Now, it sounds strange that you would need to have accounts audited in a fund where you do nothing, but the primary focus of that audit is to ensure that your fund is complying with the law. So even if you do nothing, you could still be breaching the law. Now, another disadvantage of a self-managed super fund is that it can be more expensive. You may be in a fund now where your fees are quite low and you could move into a self-managed super fund, and let's say, for example, you're going to put $100,000 into a self-managed super fund and your accountant says to you that it's going to cost $2,000 a year for your accounting, and these are just numbers. And then when you set up your self-managed super fund, you go and invest in managed funds, retail managed funds that have fees of around about 1.8% per annum to run those funds. So you've got your $2,000 fee from the accountant and another $1,800 in fees from the managed fund. So you're looking at around $4,000 a year in fees, or close to 4%, which is very expensive to run a super fund. You would not normally pay anywhere near that in a retail fund. So you need to be careful that if you're setting up a self-managed super fund, that you don't actually go into a structure that is much more expensive to run than what you were coming from. It's also potentially subject to more legislative changes. Just as an example, there are sections of the Superannuation Industry Supervision Act that relate only to self-managed super funds. Things like investing in collectibles, which is a new one that's about to come out. They're now allowing you to invest in art, but I don't think they're going to allow you to have wine collections and fancy cars, so you need to be careful about things like that. Okay, so what can you invest in? If you've decided, well, I can probably do it cheaper, what do I really want to invest in? Under the legislation, you must invest effectively for retirement purposes. Your investment can't be for today. Your investment has to be solely for retirement purposes, to provide you a benefit in your retirement. We also always suggest to trustees that if they take a common sense approach and say, Invest as if you're investing for someone else that you cared about, not just someone else. So if it was my mum, if it was my mum's superannuation, would I want to buy that bottle of wine as an investment? Now, if you'd say, no, I probably wouldn't buy that bottle of wine as an investment, you have to question the purpose or what was the reason for making that investment within the fund, because you really need to know that you're investing for the future and for your retirement. We suggest that you primarily invest in direct investments from a cost point of view. Now, it's difficult for me to give investment advice to say that a direct investment is either better or worse than a managed investment. So I'm not trying to say that you will make more money or less money from direct investments, but I explained previously that if you have a self-managed super fund and you invest that money primarily in managed funds, then you could just go to a retail offer super fund and do the same thing and probably pay a lot less money. So if that's your way of thinking, you need to question the reasons for setting up a self-managed super fund. So when we say investing in direct investments, we are talking about property and we're talking about direct shares, because there's no management fees on direct shares. In-house assets are described as an investment where the super fund is effectively investing in the trustees and members in some form or another. So a classic example of an in-house investment from a super fund is where the fund lends money to the employer of the members, who would traditionally be another company associated with the members. Up to 5% of the value of the assets of the fund can be invested in in-house assets, but be very careful in doing that, because if you accidentally go over that 5%, then you have breached the regulations and you've got to have a management plan to get rid of that asset. Now, if that asset is something you really need in your business, you then have to sell it. So that's something that you need to take a lot of advice on before actually investing in. Exotic investments. By exotic investments, I mean things that most people would not probably want to invest in. Most people shouldn't invest in, but people want to invest in them. And we've talked about bottles of wine in here tonight. I would not usually recommend that a person invests in wine. If someone stood up in front of me now and said, I am an absolute expert in wine, I actually run a wine valuation business, and I know that in 3 years' time, this wine will be worth 4 times as much as what it is now, and I want that in super, I would say, okay. If, however, someone said, my favourite wine is Penfolds Grange Hermitage, and I think I should own 10 of those in my super fund, and then one day they get destroyed, I would have a lot of questions about that trustee and the way they're running their self-managed super fund. Now, another thing to remember in self-managed super funds is that you can't actually buy assets from the members of the fund. That's, again, just another legislation that's been brought out for super funds. There are limited circumstances where you can do it, and you should take advantage of these limited circumstances. One is business real property. So if you're self-employed and you own your premises that you operate from, you can buy that premises in your super fund, and that can have massive tax advantages. So you should seek advice if you can do that. Another one is listed shares. So if you own listed shares, you're allowed to sell those shares to your super fund. Both of those transactions must be at market value. That is a rule. Okay, retirement options. Now again, retirement options aren't really different between a self-managed super fund or a retail super fund, because superannuation is a structure. The retirement legislation is the same under all super funds. So it really doesn't matter too much, but they're quite good. So I talk about taking a transition to retirement pension from age 60. You can actually take this pension from age 55, unless you're my age, but from age 60, it is tax-free to you. So it's great. It also means that the money invested in your super fund, the earnings on that money is also tax-free. So if you like tax-free income, these are a good idea. And I like tax-free income. It's one of my favourite types of income. Now, a pension from age 65. And when I talk about a transition to retirement pension now, I mean, if you're still working, you're actually not allowed to just take all of your super when you're 60. If you change employment, you can do it. But if you're still working, you're not allowed to take all of your super. But you can take a pension up to 10% of the value of your fund each year. From age 65, your super's yours. So you just start a normal pension from age 65, same rules as the transition to retirement pension, again tax-free to you, and again the earnings in the fund are tax-free as well. When I say tax-free, it's actually better than that, because some tax-free income has issues in other areas when you get other rebates and things like that. So it's good. Someone says you get that income, you don't pay any tax on it, but over here, something else is going to be affected, Centrelink benefits or whatever. This income from the pension is non-assessable, non-reportable income. It's like nothing. So it's really good. And you really should use superannuation as much as you can in those age brackets. Another really good thing about all super funds, but especially self-managed super funds, is what's called anti-detriment payments. And this is normally a presentation on its own. When Paul Keating's government, when Paul Keating was Treasurer, came to power, they introduced a 15% tax on superannuation, which was okay. I'm not going to comment on the policy, but the industry said that's a quasi-death duty. And they came back and said, we agree, it is. Oops, we need to do something about that. So they devised a section in the Tax Act that says if the super fund, when you die, if the super fund gives you a benefit over and above your death benefit, the equivalent of that contributions tax that you'd paid, then they will give a tax deduction to the super fund of that amount grossed up to what the income would be. So as an example, if you've put $100,000 into super during your life, you've paid $15,000 contributions tax, 15% tax as it goes in. So you've got $85,000 in your fund. You die, the fund gives you the $85,000, but on top of that, they give you that $15,000 that you'd paid in tax. That's gone. The fund gets a $100,000 tax deduction. In a self-managed super fund, when you pay that extra $15,000, it's going to you. It's just your money going back to you. But your fund gets a $100,000 tax deduction. Your kids will not pay tax for a long, 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 long time. It's a really, really, really powerful section of the Act that you need to know about. And of course, tax-free retirement, we've mentioned that. If all your money's in super when you retire and all your earnings are coming out of super, you're not going to pay much tax. Okay, some other issues about self-managed super funds. I've probably touched on a lot of them. It must be audited by a recognised accountant. There are qualifications for accountants to be able to audit a self-managed super fund. If you go and get advice, you'll be told who to go to for your audit. It won't be an issue. But it must be audited every year. In fact, if the auditor asks you for documents and you don't provide them within 14 days, you're actually breaching the legislation and you can be reported for that. Another thing that's really important is take advice before rolling over any other superannuation. If you've listened tonight and said, sounds like a good idea, tomorrow I'm going to go and set up my self-managed super fund, grab my superannuation over here, roll it into this fund, but if you had life insurance in that other fund, you've lost that life insurance. That life insurance may be something you need. So do not just go and take other superannuation before taking advice and understanding your life insurance position when you move. And remember, as I've said numerous times tonight, it can be more expensive to be in a self-managed super fund. And it's potentially subject to more legislative changes. And we've been through that. This is my favourite one. You have control of the checkbook, but you don't have access to the money yet. Okay, so sort of summarising on self-managed super funds. When should someone consider a self-managed super fund? This is not the be-all and end-all. I don't want you to look down the when to SMSF side and go, oh, he's told me to set one up, but this is just some ideas. Large account balances, more than 200,000. So ASIC has some publications that say they believe that 200,000 is the break-even point to set up a self-managed super fund from a cost point of view. If you have specific investment requirements, if you want to own direct property, if you see something tonight that makes you think, I want to own that in my super fund, it may be the only option that you have. You think you can do better. If you think you can do better, then by all means, it's up to you. Also, life insurance is still available. If you're someone that's had a super fund for a long time, have life insurance, but something's happened in your life where you would not be able to get life insurance again, it may be too risky for you to lose that insurance and go into your own super fund. Okay, so when to not set up a self-managed super fund? Well, clearly the first one is if you've got a small account balance, because you will pay higher fees. You don't want those fees eating into your retirement growth. Similar investment mix. So let's say you're in a retail fund And that retail fund is in a balanced fund, and it has 40% in Australian shares and 30% in international shares, all within managed fund, managed by good fund managers, some cash, some fixed interest, and you set up a self-managed super fund yourself and go and do the same thing, you're probably better off staying where you were, because those people are probably better at it than what you are, and it will probably be cheaper to run it. And obviously, if you lose your life insurance, then you shouldn't move over, or at least you should consider it before moving over. Okay, the last thing that I'll say about people when they shouldn't invest in a self-managed super fund is if they have a gambler type attitude towards investments. We see a lot of people set up self-managed super funds, do a lot of trading, and we just see that their balance just goes down every year. And it really isn't good to watch. You need to be careful if you're going to have that sort of attitude towards investing in your self-managed super fund, whether or not you are suited to having one in the first place. Okay, so that's basically all about self-managed super funds, whether or not to set one up, what they're good for, what they're bad for. In September 2007, and I know that's now 4 years ago, so it seems like a long time, some changes to the superannuation laws were made. And it all came about because of Telstra, interestingly. So there's always a political story to anything that changes legislation. But the government, when they first sold off Telstra, they did it through a structure called an instalment warrant. And most of you would remember that. What that meant was that you partly paid the shares today, you kept receiving the dividends for a few years, and then you fully paid the shares in a few years' time. And that was done through a thing called an instalment warrant, which effectively meant the government was lending you the money for the shares, because you own the shares, and then you paid them back in 3 years' time. Now, initially they said it was okay for super funds to invest in instalment warrants, but then one day someone said, no, it's actually a borrowing and super funds aren't allowed to borrow. So the legislators looked at it and said, actually, you're right. Oops, we have a problem, because we've told all these self-managed super funds and big super funds that they should buy Telstra instalment warrants, but now they can't own them to sort that out. So they changed the superannuation legislation to allow super funds to borrow for these type of arrangements. So it was structured in a way similar to Telstra, but it still allowed you to borrow. So it's not as simple as go to the bank, get a loan, buy a property. You can't do it like that. You've got to set something up similar to the Telstra arrangement. So why has it taken everyone so long to react to this? You know, we're talking something that came out in 2007. It's now 2011, or you might be watching this in 2012. But the reason is because if something seems too good to be true, it usually is. So when the legislation changed, everyone looked at it and said, this means we can borrow to buy property. And we're all standing around looking at each other going, yeah, this means we can borrow to buy property. The banks have said, yeah, it does say that, but we really don't think that it does. So a few specialist lenders said, well, we'll get into the market, but we'll charge really high interest. And they started developing products and selling those products. And because of that, there were a few tax rulings coming, and people learnt eventually that they could actually do this. So the banks have been developing their products, and they're now, basically all of them are out there doing it. They don't like it too much, but only because you must have a limited recourse loan. So the bank only has access to the property that you're buying if you don't pay it back. They've learnt that they can now take a personal guarantee, and that's part of the new legislation that's came in recently to make it a little bit easier, but that's why they've taken so long. So you really need to structure this correctly. It's similar to an instalment warrant, where you've got separate trusts, property held in trusts by someone other than the trustee of the super fund, even though they're all related, but the loan's got to be in the name of the super fund. It is a very, very complicated structure, but it's easy enough to run once you've had it explained to you. The banks are all on board now, but staff are still not totally on board because, you know, they haven't done that many. So you really need to sit down with lots of professional advisors to do one of these. Okay, so why would you look at borrowing to buy a property in your self-managed super fund? I mean, you can go and negative gear a property yourself if you want to. So why would we look at doing it within the self-managed super fund? And the primary reason is that little thing called capital gains tax that none of us really like that much. So what do we say there? So if you've got an asset in a company name and you make a capital gain, you pay 30% tax on that within the company. Of course, then that's not the final tax. If you distribute that profit, it's a fully franked dividend and you pay tax at your marginal rate. If you make a capital gain on individually owned assets, your capital gains tax rate is up to 23.25% on the gain that you've made. So you pay tax on half of the gain at your marginal rate. CGT on a self-managed super fund asset within the or any super fund asset is 10%. Now the capital gains tax on any super fund asset in retirement is actually 0%. Now 0% is my favourite tax rate. I don't know about everyone else, but that's definitely my favourite tax rate. So any of you can do your own calculations on real estate and growth and have a look at what the potential savings can be by having your assets in a self-managed super fund or any super fund as opposed to outside of super. Okay, now another thing, we've got 23.25, 10 and 0% as the rates, but another thing is when you own an investment, you eventually want to pay it off. I guess some people would say, no, you don't. You might just go to others. But at some stage, you want to make a principal repayment off your loan. The interest is great because you get a tax deduction for it, so it's not too bad. But at some stage, you want to make a principal repayment. So let's just think about someone that wants to make a principal repayment of $10,000 off a loan. Now, most of you would understand that for you to get $10,000 from your salary, you need to earn more than $10,000 because they're going to take tax off it. So you'll earn an amount, take the tax, you're left with $10,000. So consider a person on $97,000 a year who's on a 39.5% marginal tax rate, and they want to pay $10,000 off their home loan. So what do they have to earn to be left with $10,000? The amount is actually $16,529. So if your employer said to you at the end of the year, I'm giving you a $16,529 bonus that you've got, it's taxed, you get $10,000, you can pay $10,000 off your loan. If, however, you were to get that $16,529, or if you wanted to salary sacrifice a bonus into super, and say, well, I'll put that to super to pay off the loan, you only need $11,765. Because if you take an $11,765 bonus and put that into super, you don't pay any tax. Your super fund will pay that $1,765 tax, and you have $10,000 left to pay off your loan. So if you still had the $16,000 bonus, then you're going to be left with about $14,000 to pay off your loan. So you can see that the actual loan would also get paid off a lot quicker by owning this property in super. So we've talked about the capital gains tax benefit, but you're also going to own the property a lot quicker by doing it through super. So you can see that that's $2,882 in your pocket. Now, obviously it's better for someone on the 46.5% tax rate because you need to earn more to get that $10,000 amount. But another good thing is quite often in the early years of owning an investment property is you can get negative gearing. So you might have rent, but you've got some depreciation. So you might actually have some tax losses in your super fund. Now, if your super fund makes a tax loss, that can offset the contribution you've just made. So when we talked about the person making that $11,765 contribution to their super fund, if the super fund has, say, depreciation losses in that for the year on that investment property, they don't pay any contributions tax. So you've got the full $11,765 being paid off the property. Now remember also, we talked about that wonderful capital gains tax rate of 0%. Remember I said that was my favourite rate, and I guess it's your favourite rate too. But we all know when we're investing in negatively geared property that has big depreciation, at some stage in the future, that depreciation comes back to bite when you sell the property because you have to pay capital gains tax on the amount that you've depreciated the property. If that capital gains tax rate is 0, it doesn't bite too hard. So there's another advantage of doing it in self-managed super. You can claim all of your non-cash tax benefits like depreciation keep the property till retirement, you don't have to pay tax on recouping it. It's a win-win. Just an example structure of how, this is why I said it was complicated, of how the structure works for borrowing to buy inside of property. So up here, you have the self-managed super fund. The lender, being a bank, lends the money to the self-managed super fund. You are the member of the fund. Down here, you're buying a property. But remember, the self-managed super fund isn't on title to the property. You have a property trustee and sort of setting up a property down here. So the legal owner of the property is not the actual super fund. So the legal owner of the property has to give a mortgage to the bank, but the loan goes to the self-managed super fund. The property here can be leased out to a tenant. The rent goes back to the super fund. If I've confused you, that's because it's confusing. So don't stress that you don't understand it. A few other things just to understand with the structure. Up to 4 members only. Another rule with self-managed super funds, you can't be an employee of another member. You can't stitch your staff up. You can't go, I'm setting up a self-managed super fund myself, my husband or my wife, and my 2 employees, so they put all their super into my fund and I buy my property. You can't do that. They're protected. If you're going to set up a residential property, everything must be at arm's length. You can't actually rent it out to a related party. You can't rent a residential property to your son or your daughter or your wife. You can rent a commercial property to a related party, which is quite good. It's business real property. It's one of those exemptions. The other thing to remember when setting up this structure, it must be an acquisition. You must be buying a property. Can't be one you already own in a super fund. Remember, the tenant must pay arm's length rent and can't be a relative or an associate of the super fund. Okay, so loan structures. So what are the loan structures that you can get for these? The most common one, well, it's a limited recourse loan. So the bank only has a recourse to the property being sold. So if you bought a $500,000 property, house and land, borrowed $400,000, forgot to insure it, and it burnt down and is now only worth $200,000, that's all the bank can get. So the bank says, well, we want to charge a little bit more for this, and the LVRs aren't quite as high as they normally would be, rate for risk. However, now it's unlikely again that everything you do going forward is going to be through super. Most of you probably own property outside of super, and you probably will continue to do that. Super is one of the other ones that you can use, so you need to think about keeping access to some money outside of super as well. So the first type is the bank lends the money to the super fund with support from the members. And what I mean by that is the members give a guarantee to the bank so that if that transaction that I've just described occurs, so the bank can only get $200,000, they knock on your door and go, you owe us $200,000. So they'll get the money that way. That, of course, means that your interest rates are now a bit lower, and it means you can borrow more of the value of the property as well. And we have confirmed that that's a legal and a complying type of structure. Now, another way to do it is for you to go and borrow the money from the bank in your own name, and you become the lender and lend the money to the super fund. That's going to save you around $3,000 in bank establishment fees, and it's going to save you maybe 0.5% per annum in interest. So it is a cheaper way to do it, but as we said before, it's unlikely that all your future financing needs will be in super. So if you've got a lot of equity in your house and you use it to lend that money to your super fund, then you probably lose that capacity to borrow outside of super in the future. So that's a negative of that. And then, of course, there's the third one, which is just simply a loan to the super fund with no guarantees. Really, you're looking at 50 to 60% loan to value ratio there, and you're going to pay a high rate of interest. Most of the banks now want the first one. Loan features. The loan to value ratios, currently for residential properties up to 80% per annum, and for commercial properties up to 70% per annum. So it's fairly standard. There is no mortgage insurance, nothing like that, so you're restricted to those LVRs. Loan terms, fairly standard. Residential up to 30 years, commercial up to 20 years, interest only, residential up to 15 years, commercial up to the full term of the loan. Now, you can pay these loans off early if you want. Remember we talked about having that money, putting it into super and paying the loan off early. You can do that, but you can't redraw it again. So again, when you're taking advice, it's a strategy that you could use to say, well, I might put all that money in super, but instead of actually paying it off the loan, I'll sit it in an account so that it's basically offsetting that loan. So if I decide I want another property, I've got a deposit. Because if you put all the money off the loan, you don't have a deposit for another property. So you need to consider that. Okay, so when shouldn't you use your self-managed super fund if you're going to borrow to buy a property? Refinance of an existing residential property. You can't do it, so it's not a case of when shouldn't you do it. If you're doing construction or development, the legislation currently doesn't allow you to do a house and land package in your super fund. So you can't do that at this stage. When you're rolling equity forward, we talked about, you've got equity, your property, you bought it for 500,000, it's now worth $1 million, you want to access that to buy another property. You can't do that within super. And short-term property investment. So not that we would be telling you when or what term, but short-term you probably would do that outside because of the costs of setting up this structure. And related tenants. If you want a house for your kids to rent, can't do it through super. And you intend to occupy the home before retirement. Now remember we said you can't have related tenants of a property owned by your super fund. You can't do that after retirement either, but after retirement there are ways that you can actually take the property as a benefit. So then you could live in it, but the super fund would no longer own it. Doesn't matter because it's your principal residence then. But if you intend to occupy the property before retirement, again, you can't do it in a self-managed super fund. Okay, the question was, can you buy and sell property in self-managed super like you can with shares? Yes, you can, providing you meet all of the other legislative requirements as well. So you could certainly say that property is a really good property, it's going to be rezoned in 5 years, I think it's a good investment, I'll buy that property now, and then in 5 years I'll resell it. Is that the sort of thing you mean? Yep, yeah, you can do that. What you can't do in superannuation is run a business. Remember I said it's all about retirement, not about today. So if you see something you think would be a really good development proposal and say, well, I'm going to buy that land, I'm going to develop it and sell it, we would suggest you consider doing that outside of super or at least take advice because you may be breaching the rules. Okay, some people don't have equity outside of super. A lot of people have borrowed up to the max outside of super and have money in super. The only way they can do to borrow to buy another property is through their super fund. They may not have servicing capacity outside of super. You might be at your limit now. You've got 9% of your salary going in, you've got rent going in, you've got fairly low LVRs. So these things are fairly self-servicing. There's the taxation benefits, and we've gone through that more than enough. We don't need to go through that again. And we've talked about the separate land tax threshold. If you are investing in real estate now and you have breached the land tax threshold, then you will pay substantial land tax on any new property that you buy. Inside of super, you get that threshold again. It can be a substantial annual saving. Costs. I know this is what everybody's only been thinking about since I started talking tonight. Now, obviously, costs will vary between advisors, between cities. So this is an indicative cost. It could be more, it could be less, depending on the person that you're dealing with. So interest rates, we're talking about normal non-discounted interest rates. Most of you now, if you go to the bank, if their normal rate is 8.5%, you'll get a loan for 7.7 or something like that. You won't get a discount on these products. It's about $2,500 in bank establishment charges for a residential property. Obviously with commercial loans, like any commercial loan, it's usually a percentage of the value of the loan. It's around about $7,000 in total from scratch to establish the structure. That's a self-managed super fund, a corporate trustee of the self-managed super fund, a corporate trustee for the property, a bare trust to go alongside that as well. So all the documentation, setting it up with the tax office and setting it up with everyone else is around about $7,000. You may also need a financial plan. We would recommend you speak to a financial planner, of course. The bank may require that you speak to a financial planner, so you may have financial planning costs on top of that as well. So you are looking at around about $10,000 or more to set one of these up. $10,000 more than doing it outside of super. So when you look at that, you say, wow, that's expensive. If, however, we go back to the tax savings and pick a capital gain of $800,000 over 20 years. Now, you're all looking at that thinking, No one's going to make $800,000 over 20 years. But if 20 years ago I said to you, pick a capital gain of 200,000, everyone would have had the same reaction. Now you're going, that's nothing. So pick a capital gain in the future of $800,000, 25% or thereabouts, 23.25% tax for an individual, that's around about $200,000. In retirement phase, it's naught in super. So you're saving $200,000 in tax for a $10,000 investment now. It's well worth it. Your conveyancing charges will be slightly higher where you've got stamping of the bare trusts and things like that. And another interesting one is South Australia is currently the only state that charges stamp duty at the end of all this transaction. So there's a way where South Australia pays double stamp duty. The other states don't have it. However, it's been announced by your government that your legislation is about to change so that you'll be in line with all the other states. A lot of people watching this won't be in South Australia, but may want to buy property in South Australia. Okay, so just a couple of case studies. Sandra's a 47-year-old partner in a firm of architects. She wants to buy an investment property for $500,000. She's obviously self-employed, so she can make deductible superannuation contributions to pay off her property. We've estimated a saving of $237,951 for Sandra by doing this in super as opposed to outside of super by making a few assumptions. So she borrowed $400,000, repaid the loan with salary sacrifice of $2,500 a month. Obviously she's now married and her husband is making some of those because that's in excess of the amount you can put into superannuation every month. Her marginal income tax rate is 46.5%. She's receiving $500 a week in rent. The property increases in value by 5% and loan interest rates average 9%. So it's just straight modelling, but the numbers are pretty huge that she can save. Okay, Robert is a general practitioner. Have we got any general practitioners or doctors or anyone here that owns their own business premises? So we're basically looking at someone who does own their own business premises. Okay, it's worth $600,000. It cost Robert $200,000 when he first bought it, but it's his business premises. Okay, Robert can transfer that surgery to his self-managed super fund. He can lend it part of the money. In some states in Australia, he does not pay stamp duty. In some, he does. He does not pay capital gains tax, providing he gets the right advice and uses his small business tax concessions. And he saves money on land tax because this property is now in his super fund. And on that example, it was $7,000 per annum. That's a really good strategy for someone who already owns their own business premises. In Robert's position, because he's lending the money to the super fund, he can make his tax-deductible contributions to super, get a tax deduction for it, and have the super fund pay the loan back. So basically he gets a tax deduction for giving himself money, and he didn't pay capital gains tax on the property, and he probably negative geared it during the term that he owned it. It sounds good, and it is good. Okay, so summary. Step 1, take advice. Do not do anything before you take advice. Do not walk away tonight, going down the pub, say to your mates, I've heard I can do this, you should do it. No, take advice first. Sit down and speak to someone about whether or not you should do this. Did I mention take advice? Good. Get finance approval. Know that you can buy a property in a self-managed super fund before you go and do it. We see people, they rush out, they buy a property, they set up the super fund and then they can't get the loan. Then they're in trouble. Finalise your structures. You need to get the structures in place. It takes 28 days for a self-managed super fund to get an Australian business number. You need an Australian business number before you can go to your other super fund and say, give me my money. They will then take 2 or 3 weeks. So you're looking at 6 weeks before you can get a deposit. So don't buy the property today. And then find your property when it's all set up. Okay, questions? Any from the video audience? None? Okay, fantastic. Thank you very much. We'll finish it there.